So this week we're doing earned income credit, which is kind of a long chapter all by itself, and I wanted to make sure we dedicated an entire class period to it so we don't miss anything. So we're not going to do any review from previous chapters today. We're just going to dive right in. So earned income credit is pretty exciting because for a retail tax office like Liberty Tax, most of our early season customers are getting earned income credit, and it's a credit of up to and over $6,000 for working families with children. Wow. And it's still for low-income working people without children is also a credit of up to about $600 or $700. It's a refundable credit, which means that even if you don't have any withholding and even if you have no tax liability, you can get this full amount refunded to you. So a lot of people are looking for that basically bonus, free tax money, as early as they can get it. So they come in, if you have a working family with 2 kids or 3 kids, and there's only one job and they get their W-2, first thing they want to do is file their taxes so they know how much money they're going to get back. Even though there is a rule that the IRS cannot issue any of those refunds until February 15th, people are still often in a hurry to get their taxes done so that they at least can anticipate how much they're going to get. When we combine this earned income credit with the additional child tax credit we learned about last Wednesday, we can see refunds of $10,000 and more for low and middle income working families that even without any withholding. So that is generally can often be as much as half of their entire paycheck for the year. So we're going to learn about earned income credit, and we're going to review due diligence that we talked about on Wednesday. And because the earned income credit is so large, it's subject to a lot of fraud and abuse. So the IRS makes us do extra work in order to help prevent fraud and abuse. So that due diligence, it used to be due diligence was just for earned income credit, then they expanded it to those other benefits. Well, due diligence applies to every portion of tax preparation, but the extra requirements used to only apply to earned income credit, now also apply to those other credits. Okay. We're also going to learn or review the difference between non-refundable and refundable credits, and then we're going to go back into learning about earned income credit again. So again, this is actually the first chapter where we learn about tax credits. We skipped ahead and did chapter 9 first instead of chapter 8. But this is a decent review. Tax credit is a reduction of your taxes dollar for dollar, whereas a tax deduction reduces your income tax or your taxable income on which your income tax is figured. So if you're in 24% tax bracket, if you have $1,000 less income, or in other words, $1,000 deduction, your tax rate is 24%, so you're going to pay $240 less taxes. However, a $1,000 credit reduces your tax directly by $1,000. And the difference between a non-refundable and a refundable credit is a non-refundable credit is subtracted off of your annual tax, but a refundable credit is added to your payments, which means that even after it's paid off your tax, the rest becomes a refund to you. All right, most tax credits are reported on Schedule 3. Some of them are reported directly on a 1040 instead, but it's a good idea. We'll probably get to quite a few of these tax credits later on in the book. Earned income credit is reported, one of those that's reported directly on the 1040 instead of going through Schedule 3. Schedule 3 has 2 pages. The first page is for non-refundable credits. And the second page is for refundable credits. Okay. So the earned income credit does not go through Schedule 3. It's reported directly on the tax return on line 27. And in 2023, the earned income limit was $63,398. So if you had earned income of less than that, you may qualify for the earned income credit. So we're on page 279 now. The earned income credit seems pretty complicated. There are 15 rules for earned income credit, but a lot of these rules are retreads of stuff we've already learned before. So the first 7 rules are rules for everyone. So this is kind of like a pre-qualifying or like a first hurdle you have to pass. And this is for tax year 2023. For everyone, your earned income credit and your adjusted gross income must be below these thresholds. And these change each year for inflation. So I don't recommend that you try to memorize these numbers, but just remember like approximately where they are. So if you have 3 or more qualifying children, it's about 57,000. For anything married filing jointly, if you have 3 or more qualifying children, and about 63,400 for if you are married filing jointly. 53,000 for 2 qualifying children, 46,500 with 1 qualifying child, and 17,500 without a qualifying child. All the married filing jointly thresholds are 7,000, about 6,500 higher than the thresholds for any other filing status. Our second rule is that you must have a valid Social Security number. If you're married, your spouse must also have a valid Social Security number. And all of your qualifying children that you're claiming earned income credit based on must also have Social Security numbers. And these Social Security numbers must have been issued to you by the due date of the return. So if you had a December baby and the child wasn't born in a hospital and you applied for Social Security number after the birth, then sometimes Social Security Department takes quite a while to issue that Social Security number. So it'd be a good idea to put your return on extension, because if you file an extension, that due date becomes October 15th, and now you don't have to worry about whether they're going to issue that card or that number by April 15th. If you have a child in the hospital, normally the Social Security number is applied for right away, and you'll get that like before you even take the baby. There's just some instructions on how to apply for a Social Security number if you don't get one right away. And a Social Security card might say not valid for employment. That does not count as a valid Social Security number. And individual taxpayer identification number, which is formatted like a Social Security number, except it starts with 9. That's not a Social Security number. It's a taxpayer identification number. You can still file taxes if you aren't a U.S. citizen or resident alien, but you would use an individual taxpayer identification number instead. Okay. Our third rule is if you are married but separated from your spouse and not filing a joint return, you must have lived apart from your spouse the last 6 months of the year or be legally separated by the end of the year. Well, if you're legally separated, remember for tax purposes, you're considered not married. But the first rule, you have to have not lived with your spouse for the last 6 months of the year. So that's not even 1 day after June 30th. The rule used to be you had to just not be married filing separately, but they updated and changed that rule in 2021. So you can now get earned income credit if you're married filing separately, but you have to declare that your spouse did not live with you at all for about 6 months. The next rule is you must be a U.S. citizen or resident alien the entire year. So if you're what they call dual status, like you're a non-resident alien part of the year and resident for a different part of the year, you don't get earned income credit that first year that you became a resident alien. However, there are exceptions. If you and your spouse file jointly and one of you is a non-resident alien, you can elect to treat the non-resident alien spouse as if they were a U.S. resident. And in that case, they would you would have to report all of your income on married filing joint return. So if your spouse is, let's say, a Canadian citizen, not a U.S. resident, you would have to report all of their income from their job in Canada on your tax return. The fifth rule says you cannot file Form 2555, which is the exclusion from tax on foreign earned income. So that means what that basically is if you live and work in another country and you're there for at least a year, you can qualify to exclude your earned income from taxes. But if you do that, you can't also claim the earned income credit. So it's an either or. And number 6 is that your investment income must be below a certain threshold. Let's see, the book says 11,000, the slide says 10,300. So I'm not sure which of those is correct. It does change for inflation every year. Yeah, 10,300 would have been the 2022 figure. So it's 11,000 for 2023, and it's gone up to 11,600 for 2024. So basically, if you have a bunch of interest and dividends, you also probably have a bunch of money in the bank, and you don't, from the government's perspective, you don't really need help raising your children. But this is a hard limit. It's one of my least favorite provisions in the tax code. If you have $11,000 of investment income, you can still get the $6,000 or so earned income credit. But if you have 11,001, you lose the whole $6,000.
Now, would investment income count for corporation shares?
That would, but that's her income, so it doesn't count against you.
Yeah, I think we did that the first year.
So investment income counts interest and tax exempt interest. So even though it's not taxable, it still counts against you for earned income credit purposes. It includes dividends, capital gains, and not listed in the book. It also includes net rental income. Yeah, this used to be only about 3,000, between 3,000 and 3,500. And before, a lot of the native corporations were, well, in 2018, they got the opportunity to switch how their dividends were taxed. So before 2018, the investment income limit was around 3,000 or 3,500. And if you're a member of ASRC, you might get a dividend check of $4,000, and that would be taxable and it would immediately disqualify you for earning credit. Okay, this slide tells us what the other types of income are. Schedule E is for rental income, but it can also be S corporation income. Form 4797 are different types of gains that aren't technically capital gains. Form 8814, we've talked before. Form 8814 is your children's dividends and interest. So, but only the part that goes above the $2,500 threshold. Remember, we talked about kitty tax. So if it goes over 2,500, only the part above the 2,500 counts as investment income. So back when the dividends PFDs were like 36, 3,700, and it was all taxable, thanks to Sarah Palin, the about $1,500 of each PFD on the kids 8814 transferred to the parents' tax return. So we had some, not very many, but we had a few clients that had like 4 or 5 kids, and they have $6,000 of investment income transferring to their main tax return. So the way to avoid that is don't use the 8814, but instead file a tax return for each child. So we did a lot of extra work to help salvage that earned income credit. Another type of investment income would be income from rental of personal property. So if you, I guess Turo now is a new thing where you can rent your car. So it's just like Airbnb except for cars.
Yep.
Yep. So that would be, unless you're doing it frequently enough for it to be a business, that Turo income would normally be reported on Schedule 1 of your 1040, but it's still considered investment income. Okay. And the 7th rule that applies to everybody is for the earned income credit, you must have earned income. Remember, earned income is income you get from work, which can be a regular W-2 job, or it can be self-employment. Self-employment can also include your share of income from a partnership. So you have to actually be working for it to be considered earned income. Yeah.
Not last week, but the week before, I started a job in Pula. Rented a piece of equipment, did a bunch of work as a guy, and then he just ghosted me. So with the money that I was supposed to make from that, would that go towards earned income, or would that be?
So you did work for him, but he didn't pay you?
Yes.
Then that would not be earned income. Yeah.
So it's just a loss for the equipment that I had.
Yeah.
And stuff.
Yeah, so you would still deduct your expenses on your business return, Schedule C, but you wouldn't have any income for it. So here's Lance. His only income comes from Social Security and investments, so he has no earned income, so he cannot claim the earned income credit. We've also seen occasionally we'll have people that are used to getting these big refunds due to earned income credit and additional child tax credit, but maybe their only income in 2024 is unemployment. They got laid off from their job. You know, they lived off unemployment for 8 or 9 months or however long it lasts. And then they come back and they're expecting the same big refund. But if you have no earned income, unemployment doesn't count, then you're not going to get earned income credit. And also remember the additional child tax credit is based on your earned income. So it turns out your refund is $0, and you're used to getting 8,000 or 9,000. Okay, the next rule, this is still regarding earned income. If you have non-taxable combat pay, so if you're stationed in the military in a combat zone, your pay at that point is not subject to income tax, but you can elect to treat it as taxable income, or not as taxable income. You can elect to treat it as earned income for purposes of earned income credit. So in this case, you might have an adjusted gross income of 0, but still have earned income for the earned income credit. And that's an option. You can either include it or not include it. So you should try both ways, and our software does it automatically both ways. That would be a code Q on the W-2 for non-taxable combat pay. And you can choose to include it or exclude it. And then also recall that If you are on disability retirement from your job, so if they're paying you long-term benefits, you'll probably get a 1099-R with code 3 on it. Code 3 stands for disability. So your disability retirement pay is treated as earned income. It's treated as wages for all purposes until you reach standard retirement age. So here's an example. Linda, she's in the military, single, and provides for her only child. She has a W-2 which shows $2,000 in box 1. That's her taxable income, and $23,000 in box 12 with code Q. That's her non-taxable combat pay. So when she's calculating her earned income, she should do it both ways, with $2,000 worth of earned income or $25,000 worth of earned income, and see which way gives her the most credit. And in this case, counting it as income for purposes of the earned income credit is better. That gets her a credit of $34.41. So those are the main 7 rules. So again, to summarize, that was your adjusted gross income has to be below a certain threshold. The second rule is you and your spouse and all of your kids must have Social Security numbers. If you're married and you're not filing a joint return, your spouse cannot have lived with you for any day during the last 6 months of the year. You must be a U.S. citizen or resident alien for the whole year. You cannot exclude any of your foreign earned income. Your investment income must be under $11,000, and you must have earned income.